While it's true we can't predict the precise future for the economy, it is prudent to consider the risks as well as the central case. In this video, I consider some of these risks and their impacts on investors. What could go wrong, the consequences, and in my opinion, which risks are most likely to materialise in 2024. This video is sponsored by NordVPN, which lets you securely connect to the internet from anywhere in the world across all of your devices. So let's look at the market risk for 2024 in a bit more detail. Let's begin with considering China. Now, China's been on the radar for many investors for a long period of time as a source of potential volatility, but also sell-offs in risky assets. And at the moment, the geopolitical tension between China and the US, for example, is as high as it's been for many years. Furthermore, the Chinese economy has shown a lot of signs of weakness. There's not much demand in their economy, and we've also seen deflation, which is a sign of economic malaise. Now, this has negative impacts, not just if you invest in Chinese equity, but also if you invest in emerging market equity. And that's because many countries have very strong trade links with China. And these aren't just EM countries. For example, Japan has strong trade links, so does South Korea, but also Vietnam, Taiwan, and of course the EU as well. Also, there are some direct links because, for example, some banks have made loans to Chinese companies, and particularly in that property market, which is under duress in China. So there could be a contagion route back to developed markets via these financials which have financial links to China. Now, the most widespread concern about the Chinese economy is its property market, which seems very much to be in a bubble, which is very slowly deflating. In this graph from the Bank of England's Financial Stability Report, you can see the gradual decrease in activity in the Chinese property market. Now, because the real estate market makes up about a fifth of the Chinese GDP, that's going to potentially have very large repercussions, not just in that sector, but also spreading out to the financial sector and perhaps even spreading beyond China. And if we look at inflation in China, this is a graph from Bloomberg, you can see that at the moment, what's very unusual compared to other countries is that far from having inflation, China's got a problem with deflation. And that's just a symptom of the fact that there isn't that much demand for goods and services as the economy weakens. So I think China remains very much on the radar for risks that could materialise in 2024. Now, many of the problems that we see right now are directly a result of having higher interest rates. So here you can see 6 consequences of higher interest rates, and these are negative impacts on the economy, and we'll go through each of these in turn. And we can start with commercial real estate. Now, in the US, the commercial real estate market is a $24 trillion market. So when something goes wrong with that market, it can have big consequences, and that can spread to other sectors. So if we look at deal volumes, both in the US, but also Europe and the rest of the world, you can see how much they've collapsed since we've had higher interest rates. And this is because commercial real estate is very interest rate sensitive. It tends to do best in an environment where interest rates are low. And of course, we're probably not going back to that world anytime soon. Furthermore, if we drill into the different sectors of commercial real estate, the one which has been most negatively impacted and where foreclosures are highest is in the office sector. This is because of the change in behaviour after the pandemic. There's much less demand for office space as more people are working from home. Now, in the Fed's Financial Stability Report, which was published in October, you can see here that commercial real estate prices have fallen quite a bit from their peak, but not dramatically and not very quickly either. Perhaps this is because people are not willing to sell because they realise that they'll have to sell at depressed prices. So perhaps they're delaying sales in order not to realise those losses. But what is worrying is that if we look at a measure of valuation for commercial property, this is called the capitalisation rate. Think of it as the income received for a commercial property divided by its price as a percentage, such that if it's very expensive, the price doesn't really justify the earnings that you're receiving for the property. So that means that when commercial real estate is expensive, the cap rate is low. And that's currently exactly what we see. It's not as expensive as it was a few months ago, but you can see that it is still expensive relative to the income that commercial property generates. So I think this is a market that could have considerably further to fall, given how overpriced it was to start with. Now you might be thinking, I don't care about this, I don't invest in US commercial real estate. However, many US regional banks have loaned money to buy these commercial properties, so they could be on the hook if this market deteriorates. And if we get more foreclosures on those loans, it could have a negative impact on those regional banks. That could tighten credit conditions for the whole of the US, and that would have a big drag effect on the entire economy. So this is definitely a risk to watch for 2024. Now today's video is sponsored by NordVPN, and it's a service I've been using for some time now, and particularly I use it when I'm on the road. And that's because I'm concerned about security. If I connect to hotel Wi-Fi, there's no way I can know that somebody isn't intercepting my data as it's sent to the Wi-Fi network. And that's because of something called a man-in-the-middle attack. Also, if I'm using an app, I don't know what kind of encryption that's using, whether it's strong or weak. So when I switch on NordVPN, I know that all of my traffic is now encrypted such that they can't be any of these man-in-the-middle attacks. Even if they can see the data flowing back and forth, it's going to be encrypted. Another useful thing is that if you're in another country and you want to access your UK accounts, then it looks as if you're using a UK address. Now, if you're streaming video, you might be thinking, well, if I'm encrypting everything, it's going to slow things down. However, I've never found that to be the case. NordVPN seems to be very quick. It never slows down my bandwidth. Now, it's actually very easy to use. Once you've got the plugin installed in Chrome, which is the browser I use, it's simply a matter of clicking on this button. Then you select a country that you want to browse from. So let's say I choose the UK, and that's it. I'm now connected, and all of my traffic is now encrypted. So if I were to log into my Vanguard account, all of that data, my password, my username would be encrypted. Now, as a viewer of PensionCraft, you get a special discount from NordVPN, where if you use the URL, which is in our description, you can find it there, or use the name of our channel as your discount code, that's PensionCraft, you'll get a special Christmas discount where you get 4 extra months. And of course, this always comes with NordVPN's 30-day money-back guarantee. Another risk is bank bond assets. Now, we all remember what happened in the banking crisis in March, as Silicon Valley Bank had a run on the bank, essentially, as people were worried about its losses on its treasury holdings. Interest rates went up a lot, the price of the bonds went down a lot, and because it had lots of redemptions, the bank was forced to sell some of those treasuries at a loss, and it very quickly became insolvent. Now, this isn't a problem for many banks as long as they don't have to sell those assets. If they can hold them on their books until they mature, then the problem doesn't really materialise. However, the scale of the losses is pretty eye-watering. You can see that for all US banks at the moment, it runs between $500 and $600 billion. Now, the Fed is likely to step in to save the day if there is a systemic crisis. That's what they did in March. However, that doesn't mean that there aren't going to be any problems. So I think this is another problem that could resurface, particularly if this combines with that commercial real estate problem that we saw previously. One risk which the Bank of England sees, but strangely which the Federal Reserve doesn't see, is private credit. Now, this is a rapidly growing market in which you don't have syndicated debt, and that's issued by an investment bank on behalf of a company. It's usually rated by Moody's or S&P, and it's a very transparent and fairly liquid market. No, this is direct loans made by one company to another. So by definition, it's a very opaque market. We don't have aggregate data on the entire market. What we do have is a rough idea of the market size and how much it's grown. So this is from the Bank of England's Financial Stability Report in December, and it's based on data from the IMF. Notice that if we compare 2015 and 2023, the size of private credit has grown a lot as a proportion of the entire debt market. It's gone from a $500 billion market to a $1.8 trillion market. So still not huge compared to high yield, say, but it's getting on the radar for this financial stability report. Now, pension funds can't get enough of this stuff because it has very low volatility. You only see the price of these funds once a quarter, say. So if the price does fluctuate, you don't really know about it because you don't get regular updates. And if we look at the people who are buying this stuff, the institutions, you can see that pension funds are buying a lot of it. That's partly because it generates a pretty good return. It is high risk debt and it will generate a high yield. However, because the volatility is not reported regularly, it actually looks safer than it is. Some people have referred to this as volatility laundering. Now make no mistake, this is high risk lending. If these companies could borrow in the bond market or from banks, they probably would. But because they don't have sufficient credit quality, they go to the private credit market instead. Now, if this market does deteriorate, it's a problem because it's likely this stuff will be highly correlated. It won't just be one set of loans which go bad, many of them will go bad at the same time. And in this flowchart that you can see from the Bank of England, you can see how that could have a negative effect on the UK economy. Essentially, it comes from losses generated by loans going bad. Then lending costs spike as a result because people are worried about lending. And as a result, credit conditions tighten and that acts as a drag on the economy. So what could happen is that private credit could be the fuse which triggers a problem in the credit markets overall. Now, one of the direct impacts of higher interest rates is greater debt servicing costs for our mortgages. And as the Bank of England has said, we're only about halfway through of the effect of higher interest rates on the property market. To put some numbers around that, they estimate that around 55% of households have now started to refinance at higher rates. And this is since rates started to rise very sharply at the end of 2021. So that's about 5 million households which have been affected so far. The Bank of England estimates that another 5 million households will be affected by 2026. And for the average household, they think that it'll increase their mortgage payment costs by around 39%. That's around £240 a month. Now, of course, if you're working to a tight budget, that could be a huge problem. While it might not result in you losing your house, it almost certainly means that many people will have to cut back on spending, and that's going to reduce corporate profits, and that in turn will affect UK stocks. Now, this is less of a problem for the United States, where you have 30-year mortgages, so you can just stay put in a house for longer if you've locked in a good rate. However, if you do have to move, you can see how dramatically the cost of servicing the average household's mortgage is going to be now compared to where it was just a year ago. We're talking about monthly charges of around $2,900, whereas previously it was about half that, or $1,500. So you might expect that US house prices would have fallen off a cliff. However, that hasn't happened. And although they have fallen, particularly in regions that were egregiously overpriced, like San Francisco, what you can see at the moment is that they seem to have leveled off. So instead of a year-on-year fall, what we now see is prices that are just about stable over the last year. Now, just as we saw with the commercial real estate market, if we look at this measure of expensiveness for US property, this is one that's often used by the Fed, it's based on owner's equivalent rent, you can see that prices are still elevated relative to fundamentals. So potentially there could be more pain to come in the US property market as well as the UK property market, or at least a period of soft price growth. One market that hasn't suffered ill effects so far is the corporate credit market. That's certainly true in aggregate. For the UK, for example, if we look at the debt servicing costs relative to the amount of outstanding debt, it's actually falling. However, in certain sectors, which is what you can see beside me here, there is going to be difficulty servicing debt because the interest coverage ratio, which is how many times the company's profit can cover its interest payments, is low in some sectors and forecast to get even worse. So if you look at the wholesale trade, for example, you can see that by the end of 2023, many companies, about 60% of them, will have low interest coverage ratios. And construction and real estate are two other sectors where that's going to be a problem. So we could see loans going bad in these sectors, and of course that could have problems with banks losing money and tightening credit conditions for the rest of the country. Now for the US, large companies also have a lot of leverage on their balance sheets right now. That's the graph you can see here on the left. And we've also seen a deterioration in US interest coverage ratios. So perhaps this is a problem which won't be unique to the UK, maybe it'll also be a problem in the US. Now you're probably familiar with the idea of a run on a bank, but the principle of runnable money is much broader. Now what we have seen is deposit flight from UK banks. Presumably that's because they don't offer very high rates of interest. People are probably moving their money to sources of higher rates of return. So that could be term deposits with banks, where you lock in your money for some period of time, maybe a year, maybe 2 years, and get a better interest rate. Or perhaps they're moving their money into money market funds. However, I don't think this is going to trigger a banking crisis, because if you look at net interest margin, which is the difference between the rate at which banks borrow and lend, that difference is still pretty big. That net interest margin remains high. Furthermore, the economies around the world have proved surprisingly resilient. So as long as growth doesn't deteriorate too much, I don't think we're going to get a banking crisis. But it is true, if you add up all of the runnable money, as you can see in this graph from the Federal Reserve's Financial Stability Report, it adds up to a staggering 80% of US GDP. Now, a big chunk of that is uninsured deposits. These are holdings at US banks which exceed the FDIC guarantee. Money market funds also make up a big chunk of that runnable money. So one risk scenario might be that interest rates start to fall once the Fed feels that it has inflation under control and money floods out of banks, out of money market funds, as they no longer offer such attractive rates of return. However, I think where that money's likely to go is into the stock market. So while this might create liquidity problems for banks and money market funds, I don't think this is going to create a systemic problem. But again, this is definitely one to monitor. So I said I'd talk about which risks I think are most likely to materialise in 2024. And I think the biggest risk is simply that rates stay higher than we expect for a longer period of time. The US labour market remains very tight, so does the labour market in the UK, and that means that central banks will probably need to keep rates tight for a long period of time, probably long after inflation has come down significantly. We could also get a secondary spike in energy prices, and that could trigger a secondary round of inflation, which could also lead to tighter monetary policy. I think the Chinese property market is definitely one to watch. If that does escalate the problems that we've seen there and it starts to spread outside China, then that could be a real problem for global markets. If we do see runnable money running, then I think that could be a problem for some banks and for money market funds if they can't sell their assets quickly enough. So that might create a kind of liquidity problem in markets like commercial paper, for example. And then finally, I think banking stress could be a problem, particularly for regional banks in the US, if these commercial real estate loans start to go bad. The resilience of the US economy is certainly a mitigating factor there. However, I think that could still be a problem, and the Fed might have to step in yet again. So those are the most material risks which I see for 2024. I think it's always interesting to read these financial stability reports because these tail risks can be very scary. It doesn't make me change my allocation. I'm still 100% allocated in equity for my core portfolio, but I think it's good to be aware of what could happen if things go wrong. Now, don't forget our offer from NordVPN. You can use the link in the description below, or just use our PensionCraft name as the discount code. And, as always, thank you for listening.